Hello and welcome to the Oneida Nation Trust Enrollment Department's video on the Miners Trust account. We produced this to walk through the process, how the account works, how the investments work, and to address a lot of the questions that we get year in and year out. Most of the questions we get can be broken down into one of three categories. The first being how the trust and the processes work, the second being how the investments work, and the third being when members become of age and have the opportunity to claim the money, how exactly do they go about doing that? I'll put the timestamps up on the screen, and if one section sounds more appropriate to you, feel free to jump ahead and go right to that section. Part one is going to be how the trust works, and I thought a good place to start would be how the money got there to begin with. One of Oneida's per capita payments goes to everyone, and it's been Trust's responsibility to accept the money for all the children, young adults under the age of 18. So Trust has accepted per capita payments. We've deposited each member's payment into the Miners Trust account, and we invest it until members are 18 or older and claiming their money. One of the questions we commonly get is essentially, can someone take it away? And it's phrased differently of, can such and such committee decide to use the money for something else? Or should I hurry up and claim my money as soon as I'm 18 so it's not reallocated and spent elsewhere? And the short answer is no. This money has been given to you by a past budget. It's truly your money. There's no way for the nation to go back and undo all the per capita payments they've made to everyone. So it's your money, your account. Next, let's take a look at the typical timeline for a sample year in the Miners Trust. First, we'll start with where the money comes from. Per capita payments are made at the end of each fiscal year, typically September 30th, and that's when the trust account will receive the contributions into the Miners Trust accounts. Throughout the year, we're going to invest and report on the money that we have. There's quarterly mailings that are sent out to each Miners Trust account holder. Those are dated for the end of each calendar quarter. In that letter, you're going to receive two items. One is the investor statement, and the second is a fact sheet. And I have examples of what each of those look like. This is a sample investor statement. It'll have your name up in the top left, and in the top right, it indicates which of our two Miners Trust accounts you're in. This one is the 0 to 14 age account. And I think what most people, their attention immediately shifts to the bottom right. That's the closing position, market value, the $10,000 number on this screen. That represents the market value of your account as of the date listed. Here's a sample fact sheet, and there's a lot of information on this page, and we tried to make it as user-friendly and as readable as possible, but sometimes it helps to know what you're looking at, so let's break down this information. First, we've outlined a basic strategy of each of the funds, including the investment allocation. That's broken down in this paragraph on the side right here. Next, we want to make sure we're transparent with the performance of the account and how your money is doing. We've broken that down into many time frames: 3-month, 1 year, 3-year, 5-year, 10-year, and all the way back to the beginning. For reference, we've included 3 benchmarks, which is the sum of what your account is made up of. The red is the Barclays. That's an approximation for bonds or the fixed income market. The yellow is the S&P 500, or an approximation of how U.S. stocks have been doing. And the purple, the MSCI EAFE index, is an approximation for the international stocks and how they've been doing. All 3 are part of the Miners Trust account, and I would expect that the green line, the Miners Trust, to be somewhere in the middle of the other 3 numbers. Often we get the question of, what are we actually invested in? What are we doing with the money? And the answer to that is listed on the bottom of the fact sheet in these 2 columns. The left column shows which parts of the stock market or which sectors of the market we've invested your money in. In this sample fact sheet, you can see that the technology sector makes up the largest chunk of current investments, but that will vary over time. The right section then details what are the specific investments within the fund. The top two on the page there are both international stock funds, just very diversified stock holdings. The next one down is Microsoft, so the largest individual stock that we own as of the end of June in 2020, again, that varies over time, is Microsoft. Another question that we often get is how much are all these investments costing us as minor trust owners? And we want to make sure we're always very transparent and disclosing what the fees are. So in the bottom the fine print section of this fact page, there's two fees listed out there. The first is to the investment advisor, and we pay Trillium Asset Management 30 basis points annually. And the second is to our administrator. They're like the bookkeeper of all of the investments and accounts and interests and everything like that. And we pay them 9 basis points a year. Let's illustrate what that looks like. Let's take a sample balance. We'll say there's a $10,000 account. And for the two fees, the first will go to the investment advisor, 30 basis points a year, or 0.30% annually. Do the math, that works out to $30 a year. And we pay that fee quarterly. So each quarter, there will be a $7.50 charge coming out of the account. The second one for the administrator is 9 basis points, or 0.09% annually. The math works out to $9 a year. Again, we pay that quarterly, so $2.25 comes out of the account each quarter to pay for that. All in, that $10,000 account is paying almost $10 a quarter. Moving on in our sample year, here's the calendar for what the claim and deferral process looks like. Each year, about March, the department is going to mail out the payment and deferral forms and all of the tax information and the payment information that goes along with it to everyone that's eligible or could be eligible for their payment. If you're still 17 or under, as of September 1st, you're not going to get this form yet. These forms are going to be due very early in July each year. And then you have until the end of September to get all of the other information that goes along with the forms. That includes address updates, updating your bank information. You can change your tax deferral amount and provide the diploma needed if you're not age 21 yet. One of the questions we often get is, why are the payment and deferral forms due so much earlier than the September 1st deadline that per capitas and address updates and everything else in the tribe tends to work with? And the answer to that is sort of complex. Simply put, there's an IRS rule known as constructive receipt. And what that says on a very surface level is that the IRS is going to tax you on the income that you have, whether you actually receive it in your pocket or not. And this trust was established to allow all the miners to defer their taxes until they're ready to claim it, so all of their money can be earning more interest, more money for them, and they have control of their taxes later on in life. What the IRS requires this trust and others to do is to defer the money, defer their income early enough in the year so they didn't constructively receive it come September, come October, when the payments are actually being made. This forces us to have our miners choose how much they're receiving and how much they're deferring earlier in the year, early July, so that they're not taxed on the entire trust balance. They're only going to be taxed on the portion that they're receiving. Our Our department needs to be very strict on this issue. If we're found to be breaking the rule and being too lenient, the IRS could turn around and say all of the trust account will be taxed, and members will have to pay their taxes whether they've actually received money or if it's still in the trust, and that's not a situation we want to be in. Moving on, the last step of our sample year is the actual distribution time, and this is when the claimed amounts are being paid out and sent to each member, and this takes place by the end of October. I'll also add that while this is the end of the sample year, next year you will go through the same process and be required to fill out another claims deferral form if you would like to continue deferring some or all of your money. Part 2 of the video is all about the investments in the miners trust and how they work. We're going to cover why we invest the money, how the money is invested, and wrap that all up by taking a look at past performance. The why portion of the investment is simply that we want to safely maximize the assets in the account that we're holding for our miners. And one of the things that we need to overcome is inflation, or the loss of purchasing power over time. To illustrate this, a $100 item in 2020 actually costs less the further we go back in time. So 5 years ago, we could have bought that same item for only $92 instead of the $100 it costs today. A decade ago, that same item would have only costed $85. 2 decades ago, that same item would have costed only $67. So this trust enrollment committee has decided we need to invest the money to make sure it's growing and at least keeping up with inflation. Otherwise, the purchasing power of the money is going to be going down over time. If we simply stuck each miner's per cap under the mattress, so to say, the money amount would be the same, but a loss of purchasing power is virtually guaranteed. When we look at how the funds are invested, our 0 to 14 portfolio looks like this. We have about 60% of your money in stocks, equity, and that's for it to grow over time. The other 40% is in bonds or income producing type of investments. And I thought I'd take a step back first to review what those are to a beginner investor. A stock is when you take your money and you go out and buy, or you actually take ownership of a small slice of a company. Being an owner means you get to participate in all the revenues and all the profits, and as the company grows, so does your little sliver of ownership. The downside is that stocks can be volatile over time. As the markets change and as companies do better or worse than expected, you'll see their account value go up and down over time. That doesn't change the fact that you own the little sliver of the company that you do. It's just that that sliver changes in value over time. Compare that to bonds. When you invest in a bond, instead of taking your money to buy a portion of a company, you're loaning that money to a company. I think most people are familiar with a mortgage where you borrow money to buy a house, or you borrow money to buy a car, or maybe you're buying on a credit card. In all those cases, you're spending money that you don't actually have, and you're going to have to pay that money back to the bank or to the credit card company, plus interest along the way. Buying a bond is the reverse of that situation, where now we as investors have the money, and we're loaning the money to a company so they can go out and spend it. In return, we're expected to be paid back in full over time and earn some interest income along the way. The advantage is that bonds provide us that predictable income and some relative stability because we know how much we lent them and how much we're getting back when the bond is due. The downside is that the upside is not there. We know exactly the income we're going to make and the money we're going to get back, and we can't really hope to make too much more off of bonds in the meantime. One of the top questions we get is, can we lose money? And the short answer is yes. In the short term, stocks can go down based on different economic reasons, based on different company-specific reasons. And you'll certainly see market dips show up in the news, show up on the account statements from time to time. We invest in stocks for the long run, meaning this account has 3, 5, 10 plus years to grow. And we think the risk of that volatility in the short term is far outweighed by the longer term growth potential of the company. Similarly, bonds can lose money in the short term. If you see on the news that interest rates go up, and we used to own a 4% company bond and rates now go up to 5%, well, our 4% bond doesn't look as good anymore. On paper, it's going to be worth less. In reality, it's still going to pay us 4%. We're still going to get the loan amount back at the end of the bond. But over time, we're going to have to recoup that over the months and over the quarters. So you may see even the bonds fluctuate. Again, that's a risk we're willing to take as long-term investors, and knowing that we have time on our side with the accounts. Next, let's look at the performance of those investments by asset class over the years. This chart goes back to 2002. That's when we started our investment history with our current asset manager, Trillium. And it's going to show about an 18-year run, which is how long a lot of the miners have their money invested with us. So I think this is a good sample size to look at. I'll start with what simply cash has done over the years. This is $1 invested 18 years ago, and if we just put it under the mattress, we clearly still have $1 today. Next, this is what inflation has done over the last 18 plus years. $1, going back to 2002, inflation has bumped that up to $1.44. So we need to make at least $1.44 with our money, or we're going to be losing the purchasing power of the dollar we had back then. To be fair, I know putting it under the mattress is not a solution. Putting it in the bank provides some interest. So this yellow line here is a treasury bill. This is a short-term CD-like instrument. This is what the short-term banking rates have been. So instead of the mattress, if we put the cash in the bank, this is a good approximation of the interest we could have made over the years. So that dollar has grown to $1.24, still less than what the inflation is. And I think this is one of the key understanding points to one of the questions that our office gets, which is, it's phrased differently, but it's essentially, we can't afford to lose money in the miner trust accounts. Shouldn't we put their money in the bank or in a CD or something that's going to be safe so it doesn't go down? And my answer is that I don't think the CD or the bank is safe, because the purchasing power of our money will go down over the years. So while the statements show the numbers slowly going up over time, they're going to be losing the purchasing power of that dollar. And I don't think that's a safe investment for a long-term investor. The next option is the U.S. stock market. This is the highest growth option of all the options. $1 grew to $4.83. But this also comes with the most volatility, the most ups and downs. 2008 and a sharp drop was a very painful reminder of investment risks that we've experienced recently. And that's a risk that our investment committee has not been willing to jump fully into. So we're not fully invested in the stock market because we don't want to see that type of dip on anyone's account statement. The next asset class is bonds. This one has been relatively smoother, but you can see there's still a couple of minor dips there. In this asset class, bonds grew from $1 to $2.06, so seeing some good growth over time. And as you might expect, this is the Oneida 0 to 14 age trust account, is somewhere in the middle of stocks and bonds because we invest in both. This has gone from $1 to $3.38, and the drop in 2008 is about half of what the stock market drop was. So we're pretty proud to capture a lot of the upside of stocks without taking nearly as much risk as stocks. Now, the next question is, I'm getting close to distribution. I'm almost 18. I'm going to want my money soon. That 2008 drop is still scary to me, and I don't want to see that. What are we doing to protect the money for those right about to take it out? And we've invested in an age 15 plus portfolio with a different investment strategy that's much more heavily concentrated in bonds than stocks. This one is going to take a lot of the risk and volatility off the table while still providing enough upside to outpace inflation and continue growing that purchasing power for all the minor trust holders. Um, Many people have different opinions on what the right amount of risk is, and our office gets lots of calls of, this is still too much risk. What's safer? Or this is not enough risk. I want to make more money over time. What can I do? Um, and in short, can I change my investments? And the answer is no. These are the only two portfolios we offer, and we automatically shift people over after they turn 15. Um, this is done partly for our administrative sense of making sure each person's in the right investment, and also from a cost savings perspective. When we pool all the assets together and manage them as a big whole, we can really drive down the cost and save a lot of money versus giving each person the individual control to manage it how they see fit. The last question then is, how is that 15 plus portfolio done? That one doesn't quite have the same time history as the first one. This one only goes back to 2009. But if we just suppose an investor shifted over to the safe portfolio, then the dotted purple line takes over. And as you can see, it grows much slower than the first purple line. It only grows to $2.31, but it's also a much flatter, much more predictable. You're not going to see that sharp downturn in the 15 plus account. Part 3. So now you're 18 or older, you're ready to claim the money. Well, what do you need to do? The first thing is to understand the requirements. You need to be age 18 and have your high school diploma or equivalent, or age 21. Consider how much you'd like, which year you'd like to claim it in. Remember that this will be taxable income, and to figure out how it's going to affect your taxes. And everything that you don't claim will remain in your account and will remain invested in that 15 plus allocation. So probably the number one question that our office gets is simply, what should I do? How much money should I take out? How much should I pay in taxes? Tell me what to do. And our office cannot provide that level of advice. Not that we don't want to help, but we're not licensed. We don't have the capacity to take on the liability to tell you what to do. We're going to make you, as an adult, figure that out yourself. Instead, we can tell you what to think about. Um, think about how much money you're going to need and when you're going to need it. Think about the goals for the money and what you want it to accomplish over time. Someone that's going to school for the next 4 years and then looking to get a job and start saving for a house and retirement is going to have a much different distribution plan or distribution strategy than maybe someone who's needs a car now, needs to, move, or has, just a different life plan. The tax question is pretty complicated, and we're always going to recommend you find a tax advisor, find someone you can trust and that's licensed and knows all the regulations, and have them provide the advice for you, knowing your specific situation. In the most general sense, we want to share that tax brackets are progressive, meaning the more income you have, the more money you take out, the higher your average or effective rate is going to be. Someone who only takes out $1,000 is going to pay a lower percent of that to taxes than someone who takes out $10,000. And that $10,000 person is going to pay less on a percent basis of taxes than someone who takes out $30,000. So just think through how much, if the goal is to end up with the most money in your pocket, taking it out over several years could save you a lot of money in taxes. Second, the kiddie tax made news because this significantly raised the overall taxes due by a lot of the minor trust recipients. That has since been scaled back to much smaller rates, but we want to make you aware that it exists, and we're going to keep more up-to-date information available on our website. The third item here, I'd say this is more just to reassure people filling out the form. Just know that your net taxes due at the end of the year to the IRS is going to be the same no matter what tax withholding percentage you put in. The only thing you're going to change is the size of the refund you're going to get back from the government or the size of the bill that you need to pay into the government. That end number of taxes due is the same no matter what your tax deferral or tax payment number is. We've put some time into giving each member the ability to customize their distribution plan to whatever suits their needs best. The two sections of the form, which a sample is right here. Note this may change year to year slightly, but it'll generally have the same questions, is the two sections here. Section 2 is how much would you like, and this section 3 here is how much would you like withheld for taxes. And the question we get is, I want X number of dollars, so how do I fill out my form? And again, we're not here to tell you what to do. That's your decision. But I thought an illustration of how to fill out the form and the math being done in the background could be helpful. So in this example, I'm supposing a $25,000 balance. And in the top section, I'm checking the box and choosing that I want to receive 10% of my minor's trust account. The remaining 90% will stay in the account and be invested. So when we get this form, we're going to take your balance of $25,000, multiply it by 10%, and calculate your distribution to be $2,500. The next section here is how much do I want to withhold in taxes? Well, let's just say I want to make sure I don't owe in to the government for this at the end of the year. So a nice safe number, maybe 20% for me. So I'm going to check the box, yes, withhold, 20%. So we're going to take your distribution number, not your total account, not the 90% left over. We're going to take your distribution number of 2,500, multiply that by the 20% I entered on the form to get $500. So come October, when our department is distributing the funds, we would send $500 to the IRS on your behalf, and the remaining $2,000 of the distribution would be sent to you. Final key remember items for our distribution time is after you get this form in, if you need to get your diploma in, remember that's due by early September. Remember to complete your payment and deferral form annually. Each one you fill out is only good for that 1 year. Remember to seek tax advice, as these are complicated issues, and knowing what's best for your specific situation is unique to you. Remember that payments are issued by the end of October, and you don't need to call until then to make sure you have your money. And finally, remember that you are allowed to continue to defer some or all of your account until you're 30 years old. Thanks for your time and attention. I hope this has been helpful. I also know this is not going to answer every question under there, so I've provided our phone number and email address. Feel free to reach out with questions. That's what we're here for. Happy to help in any way we can.